we could have a girls' party. Isn't this what it's supposed to really be about, right? Isn't this like women on trading here? But we'll let the guys sit in on this too, right?
We've got a few blokes out there, but well, you probably don't need really much of an introduction, do you?
Are you running the show? Are you the master of ceremonies?
I am the master of ceremonies.
Good for you. I've known Tony for so many years. She used to live in Florida and be in a different part of the state.
I'm supposed to be introducing you, though.
Yeah, I know, but I'm just like, that's the nice thing about this business is the common thread of connectivity. If we're reading books and we read the names of these old masters, or we see common themes or friends, and it's not just about the trading or just about the charts and stuff, but I find that like with all the markets, it's like a whole culture, right? It's a whole separate market culture, and it's very hard to describe to somebody that's not in the markets, all the trials and tribulations and ups and downs and our own journey, as Mandy's pointing out how important it is, how much we learn about ourselves through the market,
And the market has changed so much since we started, especially since you started trading. The expos too. Look at this crowd.
I'm really impressed. I know.
It's not just a bunch of old guys. Old white guys.
Well, I'm sure.
There's a couple of you in there, but
Thank you. I did dye my hair yesterday for your honor. Yes, I know. I had to touch up those roots, so.
I didn't. Don't look closely.
See, but that's a nice thing. We can sit behind our screens and nobody has to see what we look like, too. So.
Right. So Linda got her start in the 1980s and one of the very first women out there on the floors. So really impressive. It's interesting, when I got started, I started in the mid-1990s, and my partner at the time, he's like, I gotta know Linda Raschke. I gotta know Linda Raschke. So he actually met her first. Basically wouldn't leave you alone, right? And that's how I got to know her. And she's like, oh, who's that really quiet person over there? Like he wouldn't let me get a word in edgewise. So I didn't know her from like learning trading from her or anything like that. We just got to know each other as friends to start with. And she wrote the foreword to my last book, and I got to see a sneak copy of her latest, which you guys haven't read it yet, Trading Sardines. It is out, so I recommend picking up a copy and reading it. So she is going to give us a farewell to our women in trading, and she's going to talk a little bit about history of women in trading. So without further ado, Linda Raschke.
All right. Thank you, Tony. Thank you, Tony. Everybody having a good time today? It's a little escape from the heat of yesterday. Yikes. Okay, but I know it's about 15 degrees cooler today, but still, you'll all stay inside for a little bit more seeing the exhibits and meeting the speakers and talking amongst yourselves, and back to what we were talking about earlier about everybody making a few threads, and you might see somebody if you come to one of these things again, or you meet somebody online. When I went to Australia, I went there to speak for a technical conference given in Melbourne. It was the Australian Association of Technical Analysts, these kind of professional societies that are basically yeah, because I don't sell it on Amazon or anything like that. It's only on my website. But so I met Mandy over in Australia at this technical conference, and of course, right away, there's not so many women there, and she and I are sort of similar age group or generation and so forth. And so we ended up becoming good friends. And she was the one that said to me, she's like, you don't do Twitter? And I'm like, Twitter? What's that? What Twitter? I didn't even know about all this social media and stuff like that. So she got me to do a little Twitter account and make a few posts and stuff. And I had been the first person to preach, do not have distractions during the trading day. Do not read blogs and social media and surf your email and engage in Twitter and stuff in the email. And now I'm kind of like, oh, this is kind of easy. I can just click on my chart, post it, and oh, wow. And then pretty soon you realize that there is this whole global community out there of all these different, you know, people and relationships, and that over time I think that people sort of gravitate towards one or two trading buddies, or they hook up and so forth. So Mandy and I have like a little Skype group. It's just like 2 or 3 people that I've known for 20 years, and we don't talk markets. It's not like, well, do you think it's going up or down? No, it's more like at lunchtime we're getting these random little, you know, funny jokes or things like that, just so that you know that you're not alone out there sometimes. If you're a, you know, an individual trader and you're not with a firm or a prop group or anything like that, that is part of the challenge, you know, sitting there and not getting bored and disengaging. And of course you can get up and walk around and stretch your legs, you know, throw in that load of laundry, right? I'm just joking. But you know, it's a challenge having this private workspace, but yet still not getting bored or tuning out when the markets are slow, because you just never know when they're going to come to life and present opportunity again. And it's a really fine balance, you know, if you are trading, not to all of a sudden go surfing the internet, playing with emails, playing with charts, all these things, and now all of a sudden you've sort of disconnected a little bit from that stalking trading mode, if you will. And so one of the tools has been for people to, you know, find 1 or 2 people on Skype. Mandy has a little group on Twitter that they're friends with, and it's not necessarily, do you think the market's going up or down type of conversation, but it's the camaraderie in knowing that we all have common experiences, particularly losing trades. Okay, I promise I have had more losing trades than any of you in this room. I will guarantee that, okay? I will guarantee I've had more losers than anybody out there. Probably just because I've been trading the longest, and when you're on the trading floor and making hundreds of trades a day, of course half of them are losers, you know, it's just the game. So, but we all have had big cycles in our up and down here, history and stuff. So Mandy, I invited her onto our little Skype, you know, group, which is a really lonely 3 people. And and sure enough, she would be popping in at 6 a.m. in the morning because she's over on Australian time. I don't want to know what time it is over there. Hi guys, hi guys. Oh, the Daxie's so sexy today. Sexy Daxie, you know, do, sexy Daxie, you know. I don't trade the DAX, but you know, it's like, it's fun, you know, it's a little bit of energy, and yes, we're all in this together. So she and I became friends online, and just, you know, she's helping educate me into this very sophisticated world of social media and so forth, and which I'm terrible at. And you know, I show her some of the things that I use, and so we just became really good friends online. And then she got to know Kyle, my assistant over there, but she'd never met him. And this is me, I'm a schemer, right? I'm like, how can I get her over here to the United States, you know, to hang with me in my office a little bit, because girls would have so much fun trading in the office, right? You know, girls have fun in the office. So I'm like, aha, I know. I'm going to call those people over at the Money Show. And I know that Mandy's got something to talk about and something different to say, other than here's another little indicator and strategy and stuff. So she's going to be speaking tomorrow, by the way, in the afternoon, and take things to a whole different level if you want to hear how some of her information can really you know, apply to you, and things that you can take away. But so in the meantime, she's like, okay, I booked my ticket. I'm like, great. What are the dates that you're coming in on? I'm thinking she's going to be coming for like 5 days, right? So she's like, oh, I'm flying in July 4th. And I'm like, no, you can't come into Chicago Airport, O'Hara, on July 4th. I will never be able to get back from the airport into the city because of the traffic. Do you recognize that is like a huge holiday in the United States? So then, of course, she comes in even earlier. So I have had so much fun with her for the last month, okay, and she's still going to be here for another week. And so that's how it starts, you know, and then she introduces me to somebody, and I introduce her to somebody, and then we meet some of you, and it's just the way the business is, it's so important to have, even though we're hardcore cut and dry technicals, yes, even though when we are in our own space, we have to be concentrating very much on our own game plan, methodology, what we do, you know. So you do need to keep in mind that, yes, you know, you have to have your own style, your own method, your own way of going. It's good to come to something like this and see what other people are doing and take home some ideas with you and make them your own. Okay, that's really important though, that you take something that you hear or you learn from here, even if it is a psychological thing or a mental thing or a little, you know, boost pep talk thing. Take that home and internalize it and make it apply to you, you know. And same thing with these indicators and some of the things you see. The real learning starts with everything when you go home and you start looking at the charts for yourself, okay? And it's just, I get these emails all the time like, well, can you recommend your top 3 books to read? Okay, that's a really common question. What is your reading list, you know? What indicator do you recommend? And I'm like, no. You are going about this all wrong. You learn from the markets. You learn from doing. It's like I can read about how to hit a tennis ball, right? I can read about the proper technique for a golf grip or something like that. But it's not until I go out and I play around with it a zillion times that I actually feel what it's like. And that's very much how trading is. So instead, think about printing off a chart at the end of the day with the market that you're trading or the time frame you're trading. Then go back and circle what it looks like at the turning points and start to do your own learning that way. And then once you come up with something and you see what the good stuff looks like, also go back and see where it fails, okay? See where it doesn't work. That's equally important, okay? And then you start to learn context, high volume environments, low volume environments, all this type of stuff. And that's really what this business is about, is your own learning. Mr. Market is the best teacher out there. We can give you ideas and trading ideas, but there is no better teacher out there than the market. So that's where then the camaraderie comes in, and understanding that everybody has to go through this same learning curve, okay? And the learning curve is not just about learning technical analysis or trading strategies or things like that, but then seeing it in bull markets, bear markets, dull markets, extremely volatile markets, as well as learning how we react in those markets. And as you probably have been able to glean from Mandy, there's no such thing as an ideal trading personality or ideal trading type. I mean, I have seen the most obnoxious jerks on the trading floor make huge profits, but then like the fellow that backed me was this quiet, you know, ex-physicist guy who never opened his mouth, who was the biggest introvert, who also was an equally adept trader. So just like if you sat down at a poker table, you'll have the most boisterous, loud personalities, but they could be a top-notch poker player. And likewise, you'll have the person who will not, you know, show anything and not show his cards or anything. You'll be very difficult to read, but they could both be equally good poker players. And so it's not the one personality type or the one individual. Now, what's really fun is that I did something last year for this same type of women in trading format, and you'll be happy to know there's twice as many people here as there were last year, so you know, maybe there's something good going on there. But at that time, I chose a few key women in the industry who people probably had not heard about, but it was just very, it was a very powerful statement about how you could come from any walk of life, any means of wealth, any background or education, any gender, and it seems to be multiple genders these days. I'm not quite sure, but you know, I heard that like in California they want to have its and thems and theys and no longer anything else, you know. So I'm not quite sure if I should even go there. But whatever you are, okay, you can certainly have the same edge as the person next to you. And that's what's so great about this business. It is a bottom line business. It does not care if you have a college degree. It does not care what side of the tracks you were born on. It does not care who your parents were, if or not they had money, okay? And so one of the people that was this, she was the wealthiest woman in the country. Not only that, she was the wealthiest woman in the world at that time, and her name was Hetty Green. And Hetty Green had been this, you know, terrible childhood thing where the, you know, her father had basically cut her out of the will type of thing, and even though he had had money, you know, she still had to like beg for, you know, to be able to manage this little bit of inheritance. And she was also known as the Witch of Wall Street.
Okay, so you can be a trader without having any personality whatsoever. And she would walk around in these big, long, drab garbs, hat, and it was said that she was so chintzy, she wouldn't even wash her clothes, okay? She was that frugal and that mindful about all the little pennies. But Hetty Green had it down. She knew how to buy when everybody else was panicking because she didn't really give a crap about anybody, you know. She was not an emotional person, and this was her thing. And then she would lend money and build it out, and she built up a frickin' fortune. That if you go back and you can read her on the internet. Anybody can go read a couple paragraphs about this crazy character. And I originally was familiar with her because at one time, I was a librarian for this MTA association, and there was a book in their library called The Witch of Wall Street. I'm like, I got to check this one out. So that's how I got familiar with her name. And she actually was such a miser, if you will, that she didn't leave any money to her kids. But she gave it all away. Okay, so she gave every dime she had to charity. So go figure. Okay, but here was this woman who had her own game down. She would wait for the market timing when everybody was panicking and read the crowd and so forth. She would be in cash, and as the market went up, she didn't have greed in her library. She was getting out and taking her profits, and somehow she was able to build this incredible fortune. All right, so just know that was a female at the time. And then there were, obviously women. Muriel Siepert, one of the very first females to start a brokerage firm on Wall Street. That was huge. And all these milestones along the way, we can look at them in terms of women making inroads into the business or men. But you know what? Even though I was not the first female trader on the floor, I was on the Pacific Coast Stock Exchange, and I was the second female trader on the floor. But it doesn't matter nowadays. You see, it really doesn't matter because everybody has their own skill sets. I mean, women can be intuitive, men can be intuitive. I've seen ridiculously emotional men, and I've seen women cold as ice. It doesn't matter. It's not that females are more emotional or not. Everything is a bottom line business now. You know, you just have to understand that it doesn't matter who you are or where you come from. The only thing that anybody is ever going to see is, hopefully your accountant and Uncle Sam, when you file your report that shows how much money you made or lost at the end of the year. And trust me, do not believe a lot of what you see and read out there on the internet, okay? Because unless it is documented or something, you get a lot of people that like to talk about winnings, and it makes it sound easier than it is. It's not an easy game. Nobody tweets their losses on Twitter. Are you kidding me? You only get the tweets like after they know it's a good trade, right? So don't believe that stuff. And, if I could just impart any words to you, approach this business first off as if it is the greatest hobby in the world, okay? Forget about the money making and the dollars. That will come, as does anything, when you enjoy what you do, all right? It's really important, though, because this is such a demanding business in terms of the time, the money that it costs you to come to something like this, the money that we pay for our Mr. Market tuition, okay? There is a lot that is invested in this monetary, time-wise, mentally, that it's hard for somebody to see if their job is to, be a school teacher or something. They couldn't describe to you what they experience in the classroom with the children and working with them and their frustrating moments. And equally, you couldn't describe to them all the challenges that you experience in this business, right? But if you approach it as a hobby, okay, and don't get too unnerved when we have these frustrating periods, because there are times where the market is more difficult to read or we're out of sync or something. But instead, marvel at it and think, wow, every day there's like a new pattern unfolding. It's like in nature, a new blossom or a new tree or a new sunset. Every day it's changing, and we're learning about new products or new markets or new companies or information. It's like a lifetime PhD in learning, And
No, the markets don't really change. For me, it's kind of the same game as it was 40 years ago. The market goes up, it goes down, or it goes sideways, you know. And let's just take it from there and then find our little spots, you know. And so the fascination with the charts, or, you know, with learning new technicals or reading the masters, I would encourage everybody, if you haven't already studied the works of Charles Dow and Wyckoff and you know, Gann and Schabacher, who was the father of chart formations. The good thing is that all this was written about before computers, and therefore it does hold true. A head and shoulders pattern, or a triangle, or a wedge, these types of classic chart formations are the staple in our diet. You know, they're like, okay, maybe not if you're gluten-free, but you know, we take them as the grains of our diet or something. And you know, they'll be there regardless of how technology changes, how indicators change, because they're patterns of human nature. And that's what makes the markets. And that's why we do have a profession, because individuals are very unpredictable. But crowd behavior is very predictable. And so the patterns that form through the consolidation or the panics or the, you know, these things have repeated themselves for decades, and they will continue to, you know. And that's where truly the study is, you know, going to yield you fruition, you know, in your bottom line, by understanding how there are repeatable patterns, especially with these broader chart formations, you see? So it's all good. It all ties together. We can look at stuff from like 200 years ago, or tulip bulb mania, or China, you know, the Japanese candlestick rice charting that they did. You know, they're originally were charting rice. You know, the price of rice, and you know, and here we are today. We have faster bandwidth. You know, faster processing speeds, instantaneous execution. You know, it's like, I didn't mean to touch that mouse. You know, wait, can I undo that one? You know, before you had to really think about it. When I left the trading floor, and first, you know, we're upstairs with the phone, you know, I had to call my order down to the floor. Well, that's the biggest handicap for overtrading. You're not going to overtrade when you got to call your order down to somebody else in the pit, you know. So I had this little thing that you learn to detect the signs in yourself, okay, of the way that we behave. I mean, Mandy could probably be very perceptive about this. George Soros actually is very perceptive about this, and I'll tell you a story of him. But we can start to recognize our own patterns in our behavior, right? So I could recognize my own pattern in behavior. Like if I'm in a trade and I pick up the phone and then I put it down again, you know, I'm like, well, maybe I'll just give it 2 more minutes, right? Pick up the phone, I'm staring at the screen, my eyes are bugging out, right? Put it down again, right? And I know that if I started to do this, pick up the phone, put it down, pick up the phone, put it down, get the frick out of the trade there, Linda. Okay, it's a bad trade. That's what my behavior is telling me. It's a bad trade, you know? And so you'll start to see these little funny things within yourself. So another female in the business, her name is Flavia Cymbalista, okay? And she also was a, I don't know if you want to call him coach, psychologist, therapist. She's a very interesting individual, not the traditional NLP type of school. I don't even know what she's doing nowadays, but she had this thing where learn to feel how you feel when you're in a trade. Does it feel black? Does it feel wiry? Do you feel yellow? Do you feel triangles? Do you feel like, try and, you know, be, what is it, kinesiology? Yeah, okay, she's got all the vocabulary that's better than 4 letters. Okay. So she was trying to put this type of wrap around that. So obviously what you're dealing with is some type of intuition here, and that comes from experience. You don't have intuition unless it's built up from experience, and then it's recognizing some of these feelings within yourself. So she was good friends with George Soros. And she would go up to New York, and she had lunch with him for a couple times. And you can go onto the internet and Google George Soros, Flavia Cymbalista, and see this paper that she wrote. I think it's about 15 pages long. And the topic was along the lines of
how does George Soros know what he knows type of thing. And in there, he describes very blatantly, now this is like a $1 billion hedge fund manager talking about how his body feels when he's in a trade. Okay, now, that's not what you want to hear about if you're a client, right? You hope that somebody's got a little bit better quantitative indicator than that, But he would say, well, I know I'm in a losing trade when my back starts to hurt and my back starts to bother me. And then he said, but then there's other trades where I have that trade on and I might be taking just a little bit of heat, it's not working out, maybe it's at a small loss. He goes, but it doesn't bother me at all. So somehow in his roadmap that he had built internally for himself, he had the confidence to read his own signs when something was working or it was still doing what it was supposed to be doing. Maybe it just hadn't kicked in yet. Versus when it was not a good trade and he should clearly be getting out of that trade. And I thought that was a really fascinating tidbit of information because here's, like, everybody knows George Soros' name. I'm sorry, mega billionaire type of hedge fund person, but yet he is also relying on listening to himself. And that's another thing that we learn as traders. Here's a guy that is very good at listening to his self and his own signs and his own body. So you see, we're back to this, doesn't matter if you're male, doesn't matter if you're female, it's seeing the patterns in the charts and this price behavior, and it's equally seeing the patterns within ourselves, right? So I hope that all of you, okay, if you have one or two questions, I've got plenty of time for questions because I just am like, well, I don't know what I'm going to talk about. Let's just go for it, right? And because you never quite know all the people that you're going to be speaking to, the audience that you're going to be speaking to. But clearly, all of you have a great deal of familiarity with the markets. I can see that because you're doing this, as I'm talking. Yes, okay. Yeah, I made that mistake a zillion times. Yep, done that one, Maybe not picking up the phone and hanging it up or down a couple times, but that's the tricky thing with technology, and as our mode changes, is that, dang, it's easy, this little mouse clicks, And that's the other little pattern that is one of the ways that the business has changed, and Tony was alluding to this, with these new mediums, these social medias and these Twitters and this whole other realm, and all this research about how every time you click on a mouse or you make a purchase on Amazon or you get a tweet on your phone or you text somebody, that you get a squirt of dopamine in your head, okay, which is an addictive thing. So you see, it's such an organic, holistic thing. It's not just the study of the charts, but then here we have this new medium, and are we controlling it or is it controlling us? So all the more importance, with when we do our analysis and our trading, to really make sure that you are not on these other mediums, and you'll do your best work when the markets are closed, because Mr. Market is not there doing things to get you reactive and so forth. And then when you can go in and start the day with your own game plan that you have prepared, and I know I've been monitoring this chart formation for a little bit, and there's good volume and volatility in the market, so I can feel the swings a little bit. I'm not trying to force something. And then you're there for that one trade, and you make it, and it's a beautiful thing, And the only thing I have to say is, bottle that feeling. So that if you forget what it feels like, you can go back into that closet, unscrew the lid of that jar and go, that's what a winning trade felt like. Yes, okay, and then it's like we're all back in the game again. So it is the best game in the world, and it is the most challenging game in the world, and I promise you all the frustrations and these doubts, 40 years later, I still have moments of doubts. I'm like, what the heck did I do 20 years ago? What was it that worked, 20 years ago? And then in the process of writing this Trading Sardines book, it really forced me to go back and say, what were some of the things that worked and were successful for me? And usually it was,
when I could get back into a space without too many distractions, which is hard, you know, as a single mom for a period, all this animal farm and God knows what else, right? So it's always a challenge keeping our life organized and dealing with technical issues or family issues or a zillion different issues, you know. That's always a challenge that everybody has, but you have to find a way to separate that and then go into your game mode, just as if you're playing a video game, you know. I've seen these people. The world could be coming to an end, you know, with nuclear explosions left and right, and they are in their game mode, all right? And so the more you can be able to switch your own states back and forth to game mode, now I'm in concentration mode. And, you know, we can't concentrate for 8 hours straight. Obviously, that's very challenging. But the better you can build up your own concentration and focus. There's an old saying that concentration is a muscle. The more you use it, the stronger it gets, all right? So that's a big part of the markets too. You're on your journey here, you're seeing other tools, technical things. You know we all have the same common bond, and then it's really up to you, your own concentration, and then also recognizing that it is a truly amazing game. Whether or not we make money at it is always a different issue, but the things that it teaches us, the patterns that we see, this constantly changing data and market development, it just never ceases to amaze me. And I still see things I have never seen before in many, many markets. That squeeze that we had in the natural gas market a couple months ago that was just caused by sheer derivatives. Somebody way too short, way too many options for all their clients, you know, a broker who managed to lose all of their clients' monies in their account. If you can imagine that, yes. Very, very sorry story. They sold straddles and it was just a squeeze. There was no major shortage or development other than the fact that the market was just too short. So of course it went up faster than you can ever imagine. All the accounts got shut down, about 90 of them, and they had been clients with this guy for like 10 years. So he's giving this very sorry, I'm sorry, I can't like help myself but share these little stories because it's like this is just the craziest business ever. He's giving this story on like what was YouTube, a video to his clients. Okay, he probably didn't even have the heart to tell them face to face that he blew out their accounts, right? And he's sitting there with his hands and he's like very solemn. I mean, you feel very sorry for the guy in one respect because it had to be painfully hard. But he's got like this big gold Rolex watch, you know, on his hand, and I'm like, really? You couldn't have even taken off the gold watch that you made from all those commissions from your clients and stuff like that? And there's like this old classic Booker saying, you know, from Wall Street years ago, it's the customers, the broker's yachts or something like that, all the customers' yachts. Somebody help me out here. I've been talking too much.
Where are the customers' yachts?
There you go. Where are the customers' yachts, you know? Truly, this guy's like, where are the customers' gold watches, you know? And the point of the matter is about that story is that the market went up there, extreme volatility, rotated around for 2 to 3 weeks, okay? Then over the next 2 months, it not only gave back that entire move, but then the market made all-time new lows for the year, you know? So, like, who could have ever foreseen that happening, right? It's just so amazing. Yes?
All of us have our watch list that we try to put together, and with all your experience and everything, and to help us out, what would be some of the criteria you would use to watch list? Some people won't trade stocks unless it pays a dividend, just using that as a small example. But what would you use as criteria to build a watch list, and how many things are in your watch list?
So you're talking about just stocks?
Yes.
Okay. Well, first of all, I am 100% technical.
So that makes that really easy, doesn't it? News out the window, dividend yields out the window, all this stuff out the window. I'm just 100% technical, meaning the swing highs and the swing lows and the structure in the charts. And then the second most important thing when it comes to stocks is understanding the power of relative strength. Okay, so there's a very good reason why some stocks are outperforming. I don't need to know the fundamental news or the dividends or all these types of things. So the relative strength is very important in certain types of environments. Okay, so in a bull market, you want to be with the relative strength stocks.
Are you talking about RSI or just?
No, I'm just talking about how one stock performs against another. So if the Dow is up 10%, but that stock is up 20%, it's got superior relative strength. Okay, so you can talk about alpha, beta, all these types of things, but you can also say, gee, you know, Amazon's up, you know, 300% from its last low, and General Electric is only up 5% from its last low, or it's down 5%, you see. Well, maybe there's something wrong with their business model. Maybe, you know, Amazon has a monopoly on certain things, you know. It's just, so I really believe in relative strength work, but in a momentum environment. Same thing, when the market starts to roll over and it's in a downtrend, I don't want to look to short the strongest stocks because they might not give back a whole much. But you start to see the ones that have deeper breaches of their support, you know, and these are the ones that don't have strong ownership. And so in general, you'll see it in momentum work, in that type of thing. So I only like to look at, if I'm looking at stocks, I don't have any more than 300 in my database, and I don't even trade them. You know, I might make a stock trade once every couple months.
And those are all based on RSI, or do you use other parameters to put those into your watch list?
So I don't have any RSI or anything like that. I just keep like 300 big cap stocks in there.
With those 300, how did you decide to put those into your watch list? What were the parameters that you used to build your watch list?
Liquidity, and market cap. So I want something, if I'm making a trade, okay, it doesn't really matter if it's a stock or a future or something. It takes a lot of time and energy to monitor that market, to stock it, all these kinds of things. Why the heck do I want to go missing with something that I might only be able to do like 300 shares on, and then it's a bitch to do the execution, and then I can't get out of the damn thing without slippage, you know? Why do I want to go trade thin illiquid options? Why would I want to mess with Bitcoin, for Pete's sakes, you know? Do you think I can go in and buy or sell $100 million worth of Bitcoin? Hell no. Not that I have that size account, but that means all the other big players aren't trading it either, you know? The liquidity's horrid, the slippage is horrid, you know, you can't do any bang for your buck. The real secret in this business, find something that works, do it consistently, and make sure it's scalable. Isn't that the model of American capitalism? Okay, you want to find something that you can do 2 lots, then we can do 5 lots. When I had my hedge fund, I did exactly the same thing as when I did small size, only now I could buy or sell 600 S&Ps with 1 mouse click. Why do I want to trade a market that doesn't at least afford that type of opportunity? They're good trading markets. So for me, to have a market that qualifies as a decent trading market, I want liquidity, because the biggest thing for me is get the hell out, you know? And when I want out of something, I want out of it now. That's how I am my trading. I don't want to like piece out and make it messy and get scale out, you know? And you read in my book, I'll tell you, I had lots of like, you know, outliers. I'm on the bad situations, you know. I don't know if Mandy said anything, and I'm supposed to do like a keynote later that now has been moved up to 3:30, so I'm just going to sit here and talk nonstop for the next 5 hours.
What would be a market cap that would be too low to put into your watch list?
Well, put it this way, just take the top 300 out there, and that'll take care of that, you know. And then I have like my favorites that like, you know, I've always watched for years and years and years. You know, maybe Newmont Mines isn't, you know, one of the best highest cap stocks, but I used to make markets on the options on it when I was on a trading floor. So I just happen to know that one particularly well. You know, just random things happen, and sometimes they're going to happen more with little oddball esoteric companies. You know, and the thing is, it's never a problem getting in a market, right? We can all click the mouse and get into a market, you know, but it's like, can you get out if there's really oddball events or adverse things or, you know, whatever it might be? You know, are you in a market where you can have stops and your stops will be respected? You know, there's always going to be a case in event risk where there's an extreme gap. Maybe there's, you know, a tsunami or something. So there's always event risk in the markets. And if you can't tolerate the thought of event risk, don't be in the markets. All right? It takes a definite profile of somebody that feels comfortable with risk. It does not mean that we have to hold positions overnight. But I had positions. There's a horrible story in there that I just barely eked out of, break even at the end of the day, where I was buying S&P futures, and I had just bought like 400 S&P futures, and there was that flash crash, okay? I don't know if you remember it, but the S&P sold off about 100 points in 10 minutes, okay? That would have been really, really ugly. That is a unique outlier event risk that could happen. And what had happened is I had just put on that trade. I had been stalking this for a while. I had been watching the spot, watching the intraday charts and the momentum, and there was finally my little pause, my momentum divergence, the little, you know, reaction back up, and I hadn't even had a chance to, like, you know, do the risk functions and stuff. I just was putting the trade on, and I swear in 1 minute, less than that, like 10 seconds, the S&Ps go down eight ticks. And I just bought like a couple hundred, you know? And the market doesn't normally do that, right? And the first thing that crossed my mind is like, oh crap, there's been a nuclear explosion somewhere in the world. That was the very first thing that crossed my mind. Because, you know, I was trading when they had Chernobyl. I just happened to have positions on during that too, okay? But fortunately, that was something where I didn't have any risk. But it goes choo. I'm like, holy crap, and I hit flatten on my platform. Okay, this is really important to have good execution platforms. I hit that flatten button and immediately got like another 8 ticks slippage. Okay, so now I'm down like 16 ticks on God knows, like, fortunately it was not my own account, even though I did have all my money in the fund, but it was my fund. Okay, this is still me, it's my fund. And then the market proceeded to sell off like another like 80 points so fast, or I don't even remember how many points it was. It was a lot, you know, and there was a lot of blood that day. And so what happened is that I have this big old ugly loss, you know. It's like, oh, geez, you know, Judd, my colleague, is sitting next to me, and Nigel's over on the other side. We're just kind of like looking at each other like, okay, what's going on here? And the market, you know, reams down. It starts to get a little bouncy, you know, support. I don't know what's going on, but I'm a trader, right? So now all of a sudden we've got some swings in rhythm. You go in and buy a few back, you know, and sell them out, and all of a sudden you're back trading a little bit. At the end of the day, I was back to break even, you know, after like being this ridiculous 7-digit loss. And I didn't make any money on that day, but I didn't lose any money either. And so forever since then, we always joke about, you come home, hi, honey, how was your day at the office today? Oh, okay. Anything interesting happen? No. Did you make any money? No, it was just another break-even day. And I feel like that so much of the time in this business. You're doing a damn good job if you made back those losses, you know, for Pete's sakes. Forget about making the money. You're doing a good job if you make back those losses. So sometimes the best trades are making back those losses. I know all of you have been there, so. Just don't make so many losses. Don't, try and make smaller losses, as we get more conservative and more experienced. It's just that's what a professional is. You make fewer losses. Yes, of course, looking at that match in Wimbledon, one of them hits it into the net, or one of them lobs that ball way out wide. But goodness gracious, to go 5 sets in this ridiculous, insane tiebreaker. Here are 2 professionals, and it's just who is going to make the fewest unforced errors. Okay, that's really what it comes down to in your trading, is that the more we trade, the more it's like, okay, I know what's going on. I just made this error 20 times in the last 5 years. I'm not going to let that happen to me again, And you start to get a little bit more responsible and prudent and quicker to recognize these things. And pretty soon, you're making smaller losses, smaller errors, and making them less frequently. And that's the point on your equity curve that it can start to get more parabolic to the upside. And so it's a process. It takes time. Yes?
When you had your fund, at the end of the year when you look back, at what point would you say that was a great deal? What return would you have said, I'm really proud of this?
Well, that's an interesting question, because there's all kinds of other benchmarks out there, such as your Sharpe ratio, the risk, that you're taking, and so forth, because it's not necessarily how much money you made or what % you made, okay, because that could have just been due to the particular environment or an exceptional win. Perhaps you happened to be long put options during that crash in 2008 and the sell-off in 2009, right? Is that going to be a repeatable act? Probably not. So you have funds out there that made spectacular gains on, the derivative products and this whole mortgage thing and stuff, but they're not going to be repeatable, okay? And then you also have the issue of, trust me, it's a lot easier making ridiculously high returns on smaller amounts of money than the start, as you get larger, it's very difficult to make those same kind of returns. So it's one thing to make 100% return on your own trading account. It's one thing to make 100% return on a $5 million fund. Try making 100% return on a $150 million fund. That is a different challenge, and that was about the most I got up to, and that's really not that big in the fund world. One of the most stable statistics out there was Toby Crabell, okay, when he started his fund, and this was probably maybe 15 years ago when he was truly building up. He got up to $3 billion. And you know why he got up to $3 billion? Because he was generating 4% returns. But he was generating 4% returns without any drawdown, you see? So because he wasn't having the losses, what that allowed the investors to do would be to go into his fund and invest on 2 times leverage, 3 times leverage. See, so they're giving him money now, and they're saying, I want my money traded on 3 times leverage. And he was really smart. So now he's making 3 times the fees. And the investors are perfectly happy to be getting 8% return because you couldn't get that in the market at the time, you see? So there's all kinds of variables that go out there. Some investors, believe it or not, are very intimidated if they see a fund and it had a 30 or 40% return, because in their mind, it's saying that that particular program took undue risk, okay? And that could be a problem in the future. So there's all sorts of statistics, including how fast do you make back your losses. That was probably my best statistic, was I had a reputation for making back the drawdowns and getting to new equity highs faster than a lot of people. So my longest, they call it peak to valley drawdown, how much time goes by before you make new equity highs. And my average time was about 3 months. So if we got into a little stick and we lost some money and so forth, pretty much the investors had a good confidence factor that we could be making new equity highs 3 months later. So that's another trap when you start looking at
dollar amounts, percentage functions, and so forth. How much is your big win? How much money did you make? There's a big difference between somebody making 100% return on $5,000 and making 10% return on $1 million, you see. And it might also depend on your individual circumstances. For example, some traders might have a net worth of $10 million, but they only keep $100,000 into their fund just because they don't want the money sitting in a brokerage firm where you could risk having a PFG or an MF Global or Revco or a zillion other stories, Madoff type stories, right? Although I do have to say it is a much more regulated industry now than it ever was. But, you know, you can't look at that because it's all very different for, you know, individuals. And what really matters is what is the statistic for you over a big number of trades. Never evaluate one individual trade. Hell, my best trades were I just got frickin' lucky. You want to know the truth? You just keep playing the game. And my very first big win in that book is I was just playing my little momentum pattern that I liked to do. And I bought some soybean options. I'd never really traded the soybeans. I was a floor trader making markets in the equity options, but I had my little charting book, and I'm like, oh, this is my favorite pattern, you know, at the end of a swing, a little momentum divergence. Isn't this cute? Okay, this is like 10 years into my trading career, and so it takes a long time. I'm like, oh, let me buy some options. It's like, well, let me buy some bull spreads too. Well, let me just buy some futures. Okay, this is called the Texas hedge. Long in the field, long in the account, long every which way up or down. That's the Texas hedge. So I was obviously hedged, like betting on the upside. And you know what? I didn't know it, but this was like at the beginning of July, end of June, beginning of July, which is the absolutely frickin' worst time seasonally to be buying beans, okay? All the crops are coming, you know, the farmers are trying to sell and hedge their stuff. Beans are supposed to have a downside bias, but I was like really naive back in those days. Wide-eyed and innocent, Dorothy in the land of the Wizard of Oz after 10 years. And you know what happened? It started to rain. And it rained, and it rained, and it rained, and that Mississippi River flooded. And they couldn't move the crop down the river. So now all of a sudden the prices at the other end are going sky high. And I come in and that market went up limit for a couple days in a row. And it was like somebody just hit that little handle on the cash register and it's just spitting out gold coins left and right. And I'm like, okay, I'm hooked for the rest of my life. You know, I've still been trying to repeat that play. I haven't quite repeated that play ever again. But you see, just all good, all stories, lots of stories. So. Yes, one more question. Steve Moore Research Center, yeah.
Do you trade seasonality?
I am always aware of it now, acutely aware of it, and I did a lot of research with Steve Moore in the early 90s. I documented a lot of that in the book, the Trading Sardines book, because we had a wonderful partnership, and he would test a lot of my strategies for me when, you know, it was much more awkward to program things in those days. We didn't have, you know, the sophisticated trade, you know, databases that we have now and all the processing power, but Steve had his own programmer, Jack, and so he would program all these things. And the thing that Steve taught me is twofold. The best trade in the world is a failed seasonal, okay? Because it's a damn good reason why something is not following its seasonal curve. And so that's the power that we see, and that's a lot of what the book is about, is aberrations. Aberrations are changes in relationships that we don't normally come across, and we don't know how to deal with these things because you don't have a sample size of this past history, right? If you remember when interest rates were dropping and we saw, you know, 8% mortgages go down to 6% mortgages and the 30-year yields dropped below 4%, that was the first time in my entire life I had ever seen that before. We don't know how to deal with that. And so it's really understanding how to deal with aberrations. So a seasonal is a trade where we can say, this worked 17 times out of the last 20 years. But why didn't it work this year? Maybe there was a much stronger supply-demand in force, you know, the supply-demand imbalance, you know, exerting its force. So these are the things that technical analysis doesn't teach you. And these are the things that you're probably not going to learn about in any of the classrooms or workshops here. But these are the things that, for example, people like George Soros could recognize how to capitalize on when there was an unusual aberration in the market, and what to do with that data. And it's a very unnatural thing, because human nature, if you think about it, we are all brainwashed when we're growing up. Buy wholesale, sell retail, you know, buy it on sell, this kind of banded way of thinking. All right, we're very linear-oriented, linear people, you know, we like to feel comfortable within these relationships. We like to feel that we're in a trading range environment, you know. You don't know what to do when things start making new highs and new lows. So we're very comfortable with this way of thinking. So our first instinct when something gets really out of line is to try and force it back into this banded way of thinking. Oh, it's too high, it's got to pull back down. Or, oh, this spread is too wide, it needs to come in a little bit, you know. When instead, the way that you make money is by going with that relationship and saying, the market's making very powerful new information here. Why is it that the Dow is going above 2,000 for the first time? You know, that's very powerful information. Of course, we just poked above 3,000, but how long does it stay up there? But you get my point about, like, when we start having these new relationships, you have to understand how hard it is for us to deal with that as a trader. We don't have a model for that. And so that's just something to be aware of as you continue your progress through charting and the markets and your own trading journey, that sometimes when we come across something that we haven't ever experienced before, we want to try and capture that and put it back into the box, you know? But it might be giving us subtle, hidden messages, too, that we should at least pay attention to. So, all right.